So are we going to see the 25% drop in values across the greater Phoenix real estate market? Hey, I'm Ed Grabowski with RE/MAX Excalibur here in Scottsdale, and I'm coming at you today with your monthly MarketWatch real estate update for February 2023. So if you've paid any attention to the real estate market, you know that we are well into prediction season, really perhaps more appropriately put, hyperbole season. For instance, there is one company, one national investment firm, who has identified 4 markets across the country where we're likely to see a 25% drop in values. Then at the same time, there's other companies out there, other experts out there who are predicting that we're likely to see a 10% increase in values for 2023 because they believe that we have reached the bottom of the buyer's market. I'd say that if real estate is on your radar for 2023, try to steer clear of the headlines that are clearly designed as clickbait, but rather take some perspective of where the local market is. Let's do that for you, okay? So the headline for Phoenix would say the values are down 14.5% from the peak. But if you look back from a historic perspective, look back to 2019, the Phoenix median home value is up 54% over those 4 years, which includes a 6.3% pullback from the end of January of last year. The headline for Scottsdale would look something like values are down 15.5% from the peak. And in reality, from a historic perspective, since 2019, home values are up 52.9%, which includes a 3.8% pullback from the end of January of last year. So we actually have seen some pullback in values, but it's way more normalized and not nearly as extreme as it's being portrayed by the media. With the huge run-up in values, it's only reasonable to see some pullback in those values. There are 2 big factors that are affecting the market, the real estate market, and they are inflation and mortgage rates. So, look, we're still dealing with inflation rates that we've not seen in 40 years, and as a result, the Federal Reserve has been raising the Fed rate over the last year in order to get inflation under control. Unfortunately, from a consumer's perspective, it means that higher interest rates to borrow for everything, including mortgage rates. Now, the Fed has been super aggressive, and they have raised the Fed rate 7 times in 2022, and they did again this past week. And specifically, the first of 4 major bumps of 75 basis points, it really caused a shock to the market. And this is really where we can kind of see the peak of the market, which is about May or June of last year. So we actually saw mortgage rates in January below 3%, and they continued to increase as the Fed was raising the Fed rate to over 7% in November. And now this coupled with the fact that our value appreciation has made it very difficult for buyers in the marketplace, and it's really made it unaffordable for probably about half of all the buyers in the marketplace. Now, as we have seen some easing of the inflation numbers, now the Fed has been less aggressive since November, and we've started to see those mortgage rates kind of fall back into a more normalized range. And as of today, we've actually seen mortgage rates in that 5% range for the first time since, I believe it was September or October last year. And it's quite possible moving forward, this is going to be fairly close to what the future holds for mortgage rates. So the question is, will this translate to more buyer demand than what we've seen? Well, there are some suggestions that mortgage applications were up at the end of January. So it's probably going to take some time before we actually start to see that translate into more pendings and sold contracts on homes. But that definitely is a good sign. There's a pretty good chance that we actually have seen the bottom of home buyer demand. But it's really anybody's guess how long it's going to take for those numbers actually start to pick back up. Now, if we look at the inventory side of the equation, if you look homes available in the short term, it looks like we've had a huge spike in homes available in the market. But in reality, as far as if you look back to 2019, we were actually 35% below where we were in 2019. And new listings are actually down 2.6% from a year ago. It's not that inventory has skyrocketed. It's that we are actually moving back to a more normalized level of inventory and that homes are starting to sell in a reasonable amount of time. Now, unfortunately, as consumers, we have an incredibly short memory. Our average market time today is under 90 days, and I can tell you in any other market, this would be considered a healthy market. Well-positioned properties are still selling, but it might take some time. It might take some market exposure to sell your place. The ones who are going to be unsuccessful in this market are those who are too aspirational in their expectations. But if you let professional agents like myself help you, you're going to have great success in this marketplace. Please, please, please steer clear of those agents who are promising you something that is too good to be true. I actually spoke with a property owner this week who chose a company to sell their place because they were offering a 30-day listing contract. Ladies and gentlemen, if the market says it is going to take 3 months to sell your property, please don't choose an agent who is going to set you up for failure. This, mind you, was after the first agent had already failed to sell their place. If you hire one of these hope and pray agents promising you something that is too good to be true, you likely are going to end up selling your place for far less than you would, if it even sells at all. I can help you to avoid all of this. So let's talk a little bit about where the opportunities are in the marketplace today. This very well could be one of the best opportunities for buyers that we're going to see for years to come. Buyer demand's really at its lowest point, but it's going to improve moving forward. Buyers really need to adjust to the normal cost to borrow, a new normal cost to borrow. Those 3% mortgage rates probably are a thing of the past. I don't foresee them coming back anytime soon. Mortgage rates probably are going to stay in that 5-6% range going forward. Today, you have more options to consider than what we've had over the last few years. And you're most likely not going to have to compete with 10 plus offers on every property that hits the market the minute it hits the market, like we've seen. Sellers are more willing to negotiate. You're probably not going to have to overpay for a property, overbid a property. And about 50% of all the contracts in the marketplace, the seller is willing to participate in closing costs and buy down points to lessen your initial cost when you buy. Some of these buy down programs out there can bring down your cost for the first couple of years of ownership below today's rates, where your first year interest rate would be somewhere in that 4% range. There really are a lot of options. You just really have to be willing to take a bit of a risk in today's market. And if you're a homeowner who has been looking to transition to a new place, this could be the chance, the opportunity that you've been waiting for in order to capture that huge equity growth over the last couple of years and have the potential for and have more options to consider for your new place, and perhaps have that seller participate in buy down costs to bring your rate down closer to where they were on your existing mortgage. Really could be a win-win situation for a lot of homeowners out there. Look, if we look at consumer activity really as an indication of the direction of the market, we're probably going to recover sooner than expected. People are buying cars today at historically high prices, historically high finance rates. Pay a little attention to the Barrett-Jackson auto auction, and there sure does not seem to be any shortage of buyers who are willing to pay eye-popping sums of money, and it's all happening right here in our backyard. Over the next few weeks, we're probably going to see tons of people that are coming to the Valley, tons of people coming for the Super Bowl, the Phoenix Open, spring training, really kind of to experience a lifestyle that we all enjoy. I am expecting good things moving forward. So listen, I can help you. Reach out to me. Let's talk about how to best take advantage of the opportunities in the marketplace today. You can reach me direct, 480-359-5150. And again, I'm Ed Grabowski with RE/MAX Excalibur here in Scottsdale. I appreciate your time today, and I look forward to connecting with you. Take care.